Half an hour away from the opens in Hong Kong, Shenzhen, and Shanghai. You're watching The China Show. I'm Yvonne with David Ingles.
Good morning. Let's get to your top stories today. Calls for fiscal stimulus from China grow even louder as a world-leading stock rally loses some steam. Now, disappointing data on holiday consumer spending highlighting those challenges, of course, for economic officials. As you can see here on our board, stocks across the region catching somewhat of a tailwind from Wall Street in the tech rally there as bets on Fed rate cuts are starting to at least stabilize. And the big news out of Tokyo, 7&I surging after Bloomberg reveals that Couche-Tard has increased its buyout offer by 20% to $47 billion.
We start off with some breaking news, a policy decision from the RBNZ here, and as expected, a 50 basis point cut from the central bank in New Zealand. And what we were expecting was just that. What we're hearing from this statement so far is that they're talking about annual inflation within the target, they're converging to the midpoint now, and the economy now in a position of excess capacity. We've talked about the New Zealand economy is suffering from unemployment, and maybe, there is a risk of recession once again. So certainly you are starting to see signs that there is a pivot from the RBNZ this morning. Take a look at how the Kiwi dollar is performing. It has been declining. It's holding some of the drops here as we did see that RBNZ rate cut. But yes, it was a consensus when it comes to this policy decision. Dave.
Yeah, as you can see there, Kiwi dollar, and certainly it follows the 25 basis point cut that they delivered back in August. I mean, keep in mind, though, we're a long way from where rates were, the cash rate, at least pre-pandemic. They've taken rates up over 500 basis points. So this is almost an adjustment at the margin, if you will. So we'll find out later on, of course, what's more context coming out of the RBNZ. The briefing will be taking place, I believe, starting the top of the next hour.
Yep. Well, in the meantime, though, let's take a look at the market action. And you are seeing actually stocks do quite well here, decently, just given what we saw with Wall Street overnight. I think NVIDIA is on a 5-day run, so certainly you're seeing Taiwan open up pretty favorably there. We're up about more than 1%. Nikkei 225 is up also by similar measure. Watching Couche-Tard and that deal, sources telling us they might be upping that offer for 7&I. So we are seeing 7&I shares flying this morning. But today in this show, it's really about that letdown that we saw from that NDRC meeting yesterday and that pullback that we saw in Hong Kong. Yes, China did pare back those gains, but we're still talking about 2-year highs for the CSI 300. We're still talking about, 30% gains over the past month. So it's still one of the best sort of markets out there here right now. But where does it leave us right now that things seem to be fizzling out? We certainly saw that when it came to metals, for example. Metals slumped. We're seeing a little bit of recovery here today. So Brent crude, we're still not back to that $80 level, but we're at $77 or so. Iron ore is slightly catching a bit here. Let's look at what the Nasdaq Golden Dragon did, though. And we definitely continue to see that disappointment across some of these ADRs. We slumped some 7%, may not bode well for the open here today. But take a look at how your futures board is looking at right now, because we also got the official holiday data, which wasn't that great either, right? When you talk about, yes, volumes were higher, but per capita spending still wasn't quite at those 2019 levels as well. So the HSCEI, that was the big, I guess, cooling that we saw, right? Dropping the most since 2008, that 10% drop here, basically erasing almost all the gains that we saw during those last 5 sessions during the Golden Week holiday when A-share market was shut. Morgan Stanley having a bit of a, warning there. No more upside for most of these Chinese indices. We'll get to that a little bit. But look, A50 futures are punching 3% higher, Dave, this morning. So who knows what's going to happen today?
Yeah, it's a coin toss, isn't it? It's a coin toss minute to minute. Certainly liquidity is back in the market. Certainly it's become a trader's market again. And, we can show you later on as well. So things to watch: volume and turnover, margin debts, massive move up. And I guess that's an indication that interest is back in this market. So the question mark is day 2 of a rally on the mainland. Perhaps I would lean in favor of saying yes. How we close the day is another thing altogether, but obviously we'll only get to see, with the passage of time. The drop In Hong Kong equities yesterday actually put us right above the 200-week moving average in most of the benchmarks. So I guess something to watch later today. We might get a bounce, obviously, in Hong Kong. On top of the bounce, we'll likely see onshore. A side note here, we have a bond auction today, 3 and 7 years, so the details of that should be coming through in the next 90 minutes or so. We are in the window, by the way, speaking of fundamentals here, for credit numbers coming through and, of course, the tariff conversation there as well. Plus, we also did get some data coming through on the, as Yvonne is pointing out, official numbers on holiday spending. So here in Hong Kong, close to 1.4 million visitors during the Golden Week. So we'll see any reaction there. Right, as promised, this trading frenzy that's really gripped greater Chinese market. So turnover onshore. In fact, we hit a record 30 minutes after the lunch break with 90 minutes left. And then as you can see onshore, we took out, this is in CNY billions. And we're looking at also turnover in Hong Kong. Flip the boards, please, if we can. So certainly we're back to, animal spirits are back in the market. So we'll see where prices go. I think Morgan Stanley, to your point, has tempered expectations. A
little bit. Evercore, too. Let's bring in China correspondent Min Lo to talk us through what analysts are saying on this fizzling out of this rally. What now?
Yeah, what a head-spinning 24 hours, right? We have that big divergence between what's happening in mainland China and Hong Kong, and then you have the big drop overnight in the US, the Golden Dragon, and then you have the A50 futures pointing up, so it's like markets are all over the place now. And in terms of commentary, it's also quite split. We have an M-Life strategist saying, don't be too bearish, because even though NDRC disappointed, but we remember we said that NDRC doesn't actually have the mandate to actually increase fiscal budget deficits. So there are still more opportunities for the government to roll out that big bang stimulus that we're looking for maybe towards the end of the month. So don't act too quickly here. But then on the flip side, you have people like Laura Wang from Morgan Stanley saying she's not seeing upside on most of these indices. If we pull out the price targets that she has for next year, she's saying that only the Hang Seng China Index, that's where she's seeing some potential upsides. But the rest, she says valuation has already priced in the potential for measures, reflationary measures and asset allocations as well. She doesn't see any expectation for re-rating in the near future. And Evercore as well has an interesting take. He says President Xi probably wouldn't have liked to see, that huge market rally, because that means all the money going into the financial markets is money that is not going into the real economy, right, in terms of household spending and business investments here. Yeah, so he's saying that any sort of stimulus-driven rally, that's going to fizzle out at some point, and that's going to be a mess to clean up later. So it's good that market is taking a pause right now.
Yeah, I mean, some of the theories out there as well, Yvonne and I were talking about this before the show. I mean, if they hadn't held, if that NDRC briefing didn't take place yesterday, would the market have done differently? To your
point, might be better, actually.
Might have done better,
just follow
right?
what Hong Kong was doing, right?
Yeah, just follow the momentum.
You got to wonder why they had that meeting and didn't deliver anything new.
Yeah. Because, one of our guests out of BofA yesterday effectively talked about how it's not so much the message, but how they deliver that message and the surprise coming through in that almost this flip in the PR cycle here.
It could be the different ministries taking turn, though. Maybe the Ministry of Finance could come out later. So they're all taking turns
That's
to do that.
That's going to be the big one.
I think Morgan Stanley still expects that the Ministry of Finance has to come through
the
in the next few weeks. Yeah.
Well, they need to get their spending up, right? Because some of the $1 trillion, I think, that they've budgeted so far, they've yet to spend all of that. So, to the point of Li Chang, what did he have to say?
Yeah, so that's interesting. He met with experts and academics, according to state TV, CCTV, to seek their opinions on the economic issues that China is facing. And it seems to be a signal to Chinese leaders to really listen to the voice of the markets right now when it comes to formulating economic policies. And that's interesting given the political environment where we have seen how negative news about the economy or, deflationary stories, that sort of market chatter has been seen as quite taboo. So that meeting was closed door, but it will be interesting to actually find out how candid that was. Yeah.
Right, Min, thank you so much. We'll find out. We'll find out what markets do 21 minutes from now. It's the opening bell. Joining us here on set is Nicholas Yeo, head of China equities at Aberdeen. Good morning, sir, and it's a pleasure to see you. And we first thank you for taking the time. I know you and your team are probably extremely busy. So it's funny how we're 40% into the rally, and arguably the level of uncertainty currently about the short term is almost the same level as 40% back, 44 weeks back. Where do you think we go from here? Like how how better off are we at this point if you hadn't gotten into this rally?
I mean, by and large, I would say that the easy money is more or less closer to the end of it.
Okay.
But then again, of course, you can argue on the flip side, right? That's why the uncertainty is so high. On the flip side, you will say that, yeah, it may not be trading at a big discount to the historical average. But then when you look at EM, the emerging markets, look at some of the Asian markets, we are still a good discount, right, to our neighboring countries,
sure.
especially India. Like EM ex China is 16, 17 times.
Or half of India still.
Yeah, China is much lower, right? But then if you look at the rally that we saw yesterday, even in the mainland, okay, Hong Kong was different. Hong Kong was more or less, you can call it whitewash, that everything was down. But when you came to the China yesterday, as in mainland China, there was also disparity. And people thought that, everything will be limit up, but that did not really happen. Of course, there was the NDRC that caused that to be, to bring forward that disparity. Yeah. So people are becoming more selective in terms of what they choose. I would think that that's healthier, and it's probably the slow bull, in the literal translation from Chinese, the slow bull market is what the government wants as well, and so there's some tampering from the government in a way. If you want to read into the conspiracy theory behind the meeting, right? Which are a lot. Yeah. But by and large, looking just at not putting aside all the policy, just look at the market itself. The overbought signal is there. That's why it is prone to consolidation, and it is welcome, and we would like to see some of that. Otherwise, it's not healthy as well.
Are you still expecting more fiscal measures to come through then in the next few weeks or months? Or are we likely just going to stay in this range if we don't get any more new details?
I think the base case is still to follow through, right? I mean, it would look very bad if there was no follow through. So everything is like, the expectation has been built in, and if there's no follow through, it's not just affecting global investors. I think the key here is that the domestic investors are also in the market right now, right? People are opening an account and they do not deliver. The credibility issue might be back again, right? Because we have many false dawns. Can the government afford another one, right? I mean, part of the stimulus, if you like, the rollout of all these aggressive stimulus was also the social unhappiness, right? If you speak to people on the ground, people are not finding jobs, wages are being cut, people are not happy. And still not delivering. I think there is a lot of frustration if that happens again.
Yeah, I mean, our colleague in Singapore, Mark Cranfield, had been emphasizing an important point this week that they can't get it wrong this time because of the false dawns we've seen, and certainly that the tone and some of the sort of the new measures that they put in place, to your point, liquidity in the market, do seem to suggest they've turned the page slightly on that note. I guess my question is, has the market re-rated enough? Because something that goes up this quickly, conventional wisdom tells you, could reverse as quickly. But I'm wondering whether or not we've re-rated enough to at least a higher low moving forward. Can we assume that we're now trading at a higher range?
I think you brought a good point. My second point, the main point I want to convey is that the liquidity has come back. And we have gone from zero to hero in a very short time. I don't think it's the government interest to see the market going hero to zero in a very short time as well. So in our view, I think the liquidity, as you say, will stay much healthier. Anything above 1 trillion renminbi in China turnover is healthier. Right, that broadens the market. We talk about Magnificent Seven in the US, but what about China? It has been very narrow as well. It has been difficult, especially for fund managers like us who are not just selecting one sector. We are selecting stocks from many sectors, and the liquidity should be healthier. And I don't think it's the interest, like you say, right? It's not in the interest of the government to revert back to ground zero again. And otherwise, you just look very bad on, the PBOC and everyone coming out with all these monetary stimulus, and there could be fiscal stimulus as well. So that's where we are. We should settle at a higher liquidity level, and that will be much healthier.
Everyone was pretty shocked by this rotation out of 8 shares to the domestic markets. Do you think that can continue, or that there is a bit of a, I guess, assumption that A share market might benefit more from some of these measures.
Yeah, that is still the base assumption. So there could be some of the rotation back, sell H, buy A. But there's also one important observation that people have to make, that before the A share rally, the H share in Hong Kong has been brewing on the surface, right? It has been doing better than the A. So what happened yesterday in H in Hong Kong, it could be a prelude to what could happen in the A further down the road, right? I do not know when. Is it going to be 1 week or 2 weeks? But something like what happened yesterday in Hong Kong could be, hopefully not the kind of magnitude, 9% or 8%. Hopefully there'll be some of that correction coming in to the A share market. And I might sound bearish to you,
right.
But like I say, markets never go up in a straight line, and it's just not healthy. And it has to have some correction so that it can build on a higher level, like you say, a higher base, rather than up and down like a roller coaster. So that is something that we prefer to see. And but coming back to your question, I don't think there is a complete a single trade, sell H and buy A.
Yeah.
This could be H because it was earlier, so there could be correction.
Right.
And this will be a precursor to what could happen in A share as well. So it's a matter of timing, yeah.
Yeah, well, we'll see. I mean, 14 minutes from now, the opening bell. Nicholas Yeo, of course, will be staying with us here to talk us through further strategies as we look at Chinese equities and where we go from here. The reference rate of the day is out right now, so 705.68 against the dollar, so that is just on slightly the weaker side of estimates. So that's point number one. Point number two is this RBNZ story that's come out as well, Yvonne.
Yeah, we're getting some more lines from that statement, and you're seeing the Kiwi dollar basically back to levels that we saw since mid-August. So the Kiwi looking a little bit vulnerable here today after that 50 basis point cut. So they're saying that outsized cut was more consistent with their inflation and economic goals. They did debate both 25 and 50, but they talked about the risks out there. Uncertainty over China policy. That poses a risk to the economy in New Zealand. Also, when it comes to heightened uncertainty around the U.S. elections, implications for trade as well. So that's what was behind that. So you are seeing the RBNZ responding more, of course, to the growth concerns than inflation now, too.
Okay. Yeah, we'll get more on the RBNZ on top of the next hour, and also coming up as well, a full preview of the trading day ahead. 12 minutes away, the opening bell. Shanghai, Shenzhen, and here in Hong Kong. You're watching The China Show. Good morning.
We're watching shares of 7&I in Tokyo here this morning. The 7-Eleven operator there after Bloomberg News revealed that Canada's Couche-Tard recently increased its offer now for the company to 47. We're finally getting some updates overall. So they've upped the offer. What do you think 7&I is going to have to do?
7&I rejected the initial offer as being too low. Now it looks like it's going to be very difficult for them to not enter negotiations. This new higher price did indeed, push the shares up as much as 12%. In the meantime, 7&I has been, the news has been leaking out that 7&I has been willing to shed non-core assets in order to show a greater focus on its convenience store business. But essentially, the understanding was the ball was in Couche-Tard's court. Now with this new indicated price, the ball is now back right in 7&I's court.
Yeah, and fittingly enough, and might be a coincidence here, that we have an earnings release this week. Just give us a context on how that might color developments that right now might color that upcoming release.
Indeed. Whether it's a coincidence or not, I'll leave it up to the viewer. But in 2 days, 7&I CEO Ryuichi Isaka will indeed hold a press conference for, regularly scheduled earnings release. But I mean, he's almost certain to field questions about this new number and some of the other stuff that they've been doing. And he's going to be asked point blank, most likely, how are you going to respond to this? Are you going to enter negotiations? What are you doing to boost your stock price? And so, the timing is, let's just say it's very curious.
Okay, and we'll leave it there, and we won't say what it did to the cat. Reed, thank you so much. Reed Stevenson, our senior editor there with the latest out of 7 and I. Going into the break here, just a quick glance at how we're probably going to open, and we're probably going to open higher here in Hong Kong. And also, as you can see, as futures indicate, a day 2 of the rally onshore. This is Bloomberg. Right. It's still fairly consistent, the overall narrative that there hasn't been a normal day in stocks. So we've had successive days of massive gains, and then we had a 10% drop, and it looks like we're going to get a 2% higher open here across most of the benchmarks. The Hang Seng Tech Index fell about 14% yesterday, and futures are indicating we'll probably get another up day onshore. In fact, just the momentum, we're now at 91. So 70 indicates that we might have gone a little bit too far too quickly on the RSI. We're at 91, so we're only comparatively 2 times in recent history that we've been at these levels, post-Rona and back in 2015 and going into that boom and bust cycle. So we could actually see this hit a record today. We'll see. It depends, of course, what happens in the opening minutes.
Yep, and so far things are looking pretty good right now in terms of analyst actions to tell you about. There's certainly some calls when it comes to the banking sector, the consumption side of things as well. So what we're watching is from CITIC Securities. This is the brokerage there, raised to buy at DBS Bank. BOCOM 8 shares cut to reduce at CGS. And Jumaojo raised to buy at CMB International with a price target about 264 Hong Kong dollars. Some stocks to watch. We talked about property. That certainly is one to watch here. So Centaline has some interesting numbers. Top China cities basically saw a surge in preliminary sales for both new and existing homes. Shenzhen in particular, get this, jumping by 979% from the same holiday period last year. But things were slow last year, right? But there you go. You are seeing property stocks catching a bid here this morning. Shimao is up some 4%. And we're tracking, of course, that drop in oil prices overnight. I think we're down some 5% for Brent. Yeah, there you go. You're seeing that in some of these energy shares here this morning. PetroChina down about 1.5% right now. Brent still recovering just a bit. We're at $77 right now.
Okay, yeah. So all things point to, I think broadly speaking, we are getting the tailwinds coming out of Wall Street. So broadly speaking, Asia is doing fairly well. Hong Kong ditto, and on top of the 5% gains yesterday, it looks like we'll be opening higher at the open.
Welcome back. You're watching the China Show. It looks like we are poised for possibly a bit of a recovery here when it comes to the 8-share market here after that bruising yesterday where we dropped more than 2,000 points. That 10% drop, it looks like we're recovering just slightly. But has investor confidence been shattered? That certainly is one thing after that NDRC meeting here this morning. You're watching the CSI 300 actually start things slightly in the red here this morning, Dave.
Yeah, so I think we opened 11% higher this time yesterday, closed at about 5%. We're giving back a further 2% in the early goings. A lot of that will have to do, I guess, let's wait a few minutes because there might be some orders that got stuck. And certainly that massive pop in volume and turnover yesterday. And the other thing we're tracking today is outstanding margin debt, which, by the way, has been largely subdued and absent given the sort of 3-year bear market. So that's certainly something to watch. Now, out of the gates, as you can see, substantial losses across effectively every single sector onshore, from healthcare all the way to financials. 2.5% on healthcare. We're looking at about 3.3% in telcos. Materials are down about 2.5%. 3% on the benchmark. So you know what? At about these levels, this is probably where we closed going into the long holiday, thereabouts. Morgan Stanley has come out with their new targets, 12-month, well, not 12-month target, 10-month targets from here on. June 2025, it's at about 4,000. So I think on most of those new targets that they have, they don't expect any more upside, with the exception of one major benchmark, which is Hang Seng China. More on that in a moment. Shenzhen's off about 5.5%. In the opening bell. Right. A glance at some of the stocks that actually moved quite a bit yesterday to the upside. So SMIC was up 20%. We're down about 1.4%. Well, okay, live TV, folks. A quarter 1%. Galaxy Core is another semiconductor stock, as with Will Semi. Wuxi Aptec was also up about 20%. Now, a lot of this, of course, mirrored or was a bit of a catch-up because of Hong Kong and some of the constituents. You have 8 shares, of course, and for Wuxi Aptec as well. Right. The open in Hong Kong, and let's give this a few minutes to simmer. Hong Kong is opening up, although as you can see, we're losing a bit of momentum there. HS Tech, which fell about 13% yesterday, 47.42. We are getting, though, a slight bit across most of the index heavyweights, bottom of your screens. Of course, Hong Kong dollar has been weaker of late, but it's been stronger going into the last 3 weeks or so, just given the demand for Hong Kong dollar. And you really see that with funding costs, right, in Hong Kong. Very quickly, one chart to watch today is that arguably, if you go by the last 2 times this selling signal appeared, one was back in early 2023, the other one was 2024, when you had the RSI come back below 70. We did see sustained losses back in those 2 times. That signal has again appeared, although you could make the argument this time might be different just because of where the policy mix is compared to those last 2 times, Yvonne.
Yep, and as you're speaking, we're seeing a CSI 300 that is lower by about 5%.
Wow.
Just 2 minutes into the trade. So it's going to be a day of volatility, to say the least, but that already is close to erasing most of the gains that we saw yesterday post Golden Week reopening. Still with us is Nicholas Yeo, head of China equities at abrdn. You mentioned the easy money is done. It's time for stock selection. What is the strategy moving forward now?
And the key word here is balance. It sounds like yin and yang, but we are now in a stage where stock selection becomes more and more important, and that's good. That's healthier in terms of like market focusing more on fundamentals. We did not really have that before this rally, right? Liquidity was too low, price discovery was bad, quality companies were not rewarded. Even if you have good fundamentals, but then you were not like getting that reward from investors. But that has changed because liquidity has definitely helped to broaden out the market. So what wasn't doing very well, quality growth, is now more and more in favor. But I say it's balanced. It doesn't mean that we are chucking out all the quality defensive companies because, like I say, we want to take our clients through this sort of increased turbulence, and you do not want to be too lopsided, right? Yes. Overly biased to one side, like growth. And because like you can see here, the volatility will increase, and we want our clients to be much able to shield themselves through this turbulence. But don't get me wrong, I mean, we're not in the bear zone, but we are in a bull zone. In this bull zone, we still get that volatility, and we welcome that. And so selection will be key. Yeah.
What are the most compelling opportunities then?
We maintain a long-term view on certain themes or sectors like consumption. It may not be aspiration, but we still believe that consumption is key for the economy in the long run. And some of these fiscal stimulus, maybe, we are not 100% certain yet, may be targeting at domestic consumption, because that is still lagging behind in terms of being a driver of GDP. Right? And I think the government wants to gravitate more and more towards consumption, helping the people to spend and or nudging people to spend, encouraging people to spend. So we still believe in the consumption, and it has been beaten down quite a lot. Like I say, some of the companies that have been able to deliver the results, some of them are actually in the consumer discretionary, not so much on the staple side, but the discretionary side. Surprisingly, even with the consumption slowdown, the discretionary side of consumption was doing not too bad in certain subsectors, such as even electric vehicles. Some of the I might be hinting some names here. Some of the leaders, right? Yeah.
We know.
Yeah.
We know.
You were talking a little bit more about the high-quality defensive names, like the banks, the SOEs,
Not
and the like.
necessarily.
Not necessarily. Okay, but you're saying that these are maybe sold off a bit indiscriminately recently.
They have been laggards, yeah.
Why do you think that this could actually reverse this trade?
I would not say they will. There might be it's not binary. Like they will revert completely. Like when there is a sell-off on a growth, and then all the defensive will become super outperformer. But there is a gradual maybe gravitation as well. Gravitate more and more to a bit of both. Because some of these have been lagging behind. So it's a usual bull market where you buy the laggards.
Yeah.
Right. So this could happen. In this, like I say, we are still in a bull zone, so it's not like, you go completely defensive, but yet there will be that continuous rotation, selling off some of the winners and buying some of the laggards. So even some of the defensive names may not be just the banks, but there are some defensive consumption names, consumer names that are giving high dividends. They might be back in favor as well. And there are some names that are related to infrastructure investment, such as the state grid investment, and that's still the ongoing theme. They're still they're still doing okay, and I suspect that they have been laggards as well, and there will be some rotation into those names. So yeah.
I want to get a sense of who the converts have been recently. What sort of inflows are your funds seeing, and where are those funds coming from? Largely.
I would say by and large, our audience or our clients are mainly the Western, the Europeans, the Americans, North and South.
Those are the hardest to convince, though.
Those are the hardest to convince, so they're still skeptical. But their interest is going up. Interest to know more is going up, and that's a good sign. And there's one big difference this time around is the domestic has been a lot more involved compared to previous rally. So I think the foreigners, at least our clients, are more skeptical. They want to see more follow through before they buy the story. So I think that's fair because the experience have not been that great. Experiences of investing in China have not been that great. So it's natural human tendency to see how this is being followed through with fiscal stimulus, with other stimulus, before taking the bite. And of course, it's a double-edged sword with such a sharp rally. And we understand the reason why, because it has been oversold, it's been low valuation. But having a straight line up is very inhibitive for some of our sophisticated investors to buy on such strength, right? They would rather buy on weakness, right? So this is a good window that we are seeing. Yeah.
In terms of what's next, earnings, that certainly is one thing to watch. I think market expectations are for double-digit earnings growth. We've seen certainly a lot of upper revisions in the tech side of things. I believe HS Tech is double-digit upside revisions. Is that overly ambitious, you think, or do you think they can actually deliver?
I think the third quarter is like almost like it's past us, right? And that was before the stimulus.
Right.
So it may not be as meaningful. But at the same time, it might be a little bit funny if you have stock going up 50%, 80%, and yet you have losses, right?
Yes.
So there will be some reversion back to looking at fundamentals. Even if you have a bad results, they will still look at maybe we have been over exuberant on some names. So that's why the earnings becomes a key thing to watch in the coming weeks when they announce the result. But of course, the important thing is guidance. But guidance is a little bit early as well. They may be able to tell us what happened during the Golden Week, but beyond that, it's still wait and see. I know the overall sentiment is a little bit better than before the stimulus, but it might be too early for companies to come up with very positive guidance. So we might have to wait until end of the year. But having said that, there are still companies that have been enjoying, even before the stimulus, quite robust earnings growth. Right? We are still seeing in our companies 15-16% earnings growth, and they have not really been missing expectation. So the selection becomes key, and we are able to select those companies that are still producing the results. So that is still ultimately determines the performance. Yeah.
What else do you want to hear as a market participant from economic officials?
Not so much the short term, but the long term.
Right.
I think we're losing time. If this continues with the economic slowdown, I know it's still a very reasonable number, but you look at the shift to consumption and all that, it's not really happening. In fact, we have like gone backwards. And we are thinking of 2035 becoming a moderately wealthy society, and each year passes by with us not moving, as in China not moving in that direction, is a time, it become more crucial, like meeting that target. And don't forget that we have a demographic cliff in terms of the aging population coming in less than 10 years' time. And so we need to move quicker. So we want to see policy targeting the long-term structural issue, birth rate, having it, the pension as well, pension deficit. So these are the long-term, which may not happen in the short term. But if the government is coming out with signals and messages about long-term, I think that will be very good for long-term investors.
Nicholas, thank you for taking the time to stick with us, of course, for the most part of this hour. Nicholas Yeo, their head of China equities at Aberdeen. Lots of key messages there going into this, day two post the Golden Week holidays. And we'll leave you with a look at markets 11 minutes into the cash market session in Hong Kong and up in mainland China. And things have just been swinging all over the place. We're down now 3.3% after we fell as much as 5% at one point a few minutes ago on the CSI 300. This is Bloomberg. Welcome back to watching the China Show. Let's talk about this key vote, of course, taking place within Taiwan's corporate sector. So you had Shin Kong and Taishin Financial expected to meet separately later today to vote in this merger proposal. Cindy Wang, our breaking news editor, joins us right now to just give us a context here and what we should expect today. So, what's happened so far, if we know anything at this point, and what's the significance of this, Sydney?
Hi, David. Yes, the shareholders' meetings of Shin Kong and Taishin are taking place this morning in Taipei. And before their meeting starts from 9 a.m. this morning, there's a long line of shareholders outside of Shin Kong's venue waiting to get inside the meeting. And right now, the meeting is taking place. So far, the shareholders are taking turns making comments, asking management questions. The atmosphere is calm and in order. So it's likely we're going to see one of the biggest combination in Taiwan's financial industry in years. And it's expected that the shareholders, which we learned from local media report now, the attendance rate is more than 80% this morning for Shin Kong. And it only takes half of them to approve the case, then that means we're heading to the next stage, which is not the final stage yet because the two companies still need to get approval from Taiwan's financial regulator, FSC, to finalize these merger deals. And it's expected that both the regulator and shareholders are likely to approve the deal because Taiwanese financial regulator have been trying to boost the financial industry and make the economy less concentrate on the technology sectors. But it will take maybe up to 2 to 4 months for the financial regulator to make the final call. But it also means that if the shareholders at Shin Kong and Taishin today reject the deal, it would be a surprise to the market. And it will also mean that Shin Kong will have to come up with a solution for its struggling life insurance company. So in any case, we will be able to find out the results very soon, likely within the next couple of hours in Taipei.
Yeah, you mentioned there's been a lot of sort of twists and turns for this deal. Can you just tell us just what has happened in the last few weeks?
Exactly. This months-long saga has been full of twists and turns, and it's really dramatic. And as you can see from the share price of these two companies, their stock actually has been on roller coaster rides for the past few months. And it all started in August, in late August, when Taishin and Shin Kong made an announcement that there would be a mutually agreed merger between the two companies. Unexpectedly, there's a third player, Taiwan CTBC Financial, just unexpectedly announced that it also had a tender offer plan for Shin Kong. So CTBC's involvement drove up the Xinguang's share price, and it also drove up Taishin's offer price for Xinguang by 25%, because CTBC and Taishin, they will both need to compete to get Xinguang shareholders' approval for their offer plan for Xinguang. But unfortunately, in September, Taiwan's financial regulator, FSC, decided to block CTBC's bid for Xinguang, saying that CTBC's plan wasn't comprehensive enough and it lacks a guarantee for capital injection for Xinguang's struggling life insurance company. At one point, CTBC still considered to resubmit and revise its plan for Xinguang, but eventually it decided to drop out of this takeover battle for Xinguang due to the repeated opposition from the regulator. So in any case, if we're going to see a merger approved by both company shareholders today, it will likely create the fourth largest financial companies in Taiwan, and it will be the first financial transaction in Taiwan's finance industry since 2022.
All right, Cindy, thank you. Cindy Wang there, our Bloomberg Breaking News editor, joining us out of Taipei. We'll watch very closely what goes on with that vote here today. Some breaking news that we're seeing here on your terminals. So the U.S. says it's now weighing a breakup for Google as a remedy in this monopoly case. That certainly would be a big, big deal as they try to break up, or will they try to break up this company? So certainly it's been something that we've been talked about for some time now. And is the government really going to set an example of all this by breaking up Google? And if they do so and continue on, it could be one of the biggest sort of anti-monopolistic acts we've seen since there was an attempt to carve up Microsoft maybe about a quarter century ago. Yeah.
Well, I vaguely recall the details of that, and certainly the fact of how significant developments there were, I guess, underscores really what this is likely to look like. But again, we have to emphasize at this point in time that it is one of the options so far. The breaking up as a potential solution here. Just a bit of background, of course. I think it was back in the summer that there was a federal judge in that ruling, maybe stemming from that conversation to this point in time. We're not really seeing much market reaction. Once we do have more details on this breaking news, we will get them to you as soon as possible.
Yep. And how does that really kind of pair with their generative AI ambitions and the like? That certainly is going to be a key question as well. Let's stick to the whole AI theme. Not really, but tech mostly. If you take a look at what we've been talking about in Taiwan this week, and it really was the Hon Hai Tech Day, right? The chairman, Yong Lu, is saying the company is planning to boost server capacity to meet stronger than anticipated demand for NVIDIA's AI chips. Now, speaking to us at the firm's Tech Day in Taipei, they'll disclose for the first time how many servers they plan to make for next year.
We see the demand is over what we can ship.
So if you can't meet the demand right now, how long do you see that extending for? What sort of sales do you have booked going into next year as well?
We see in maybe somewhere around 20,000, that kind of a number.
You're looking to ship 20,000 AI servers made with Blackwell chips over the course of next year, is that right?
Right.
Okay, and any particular quarter that you're looking at in particular for that, or do you see it being
spread out? It's not per quarter, that's a year.
Yes, but per quarter, are you expecting a bulk of those to go in one particular quarter, or do you see it spread evenly across the course of this year, or next year rather?
It really depends on once we start shipping, the demand, whether the demand will change or not. If the demand doesn't change after we start shipping, and the demand will be even higher than we expected.
In terms of profit margin, then, what I understand for AI servers, it can be in the low teens. Do you see a way to expand that and to increase it?
I think in the low teens, you're probably right, but that will have to be based on how much vertical integration, how much components that you're able to provide. So with that, it varies to a certain degree. But because the CPU and GPU is very high price, so the rest of the server, has only some limited impact in terms of overall cost.
Okay, that was Hon Hai Chairman Young Liu speaking with our tech reporter Bell Jewelers, of course, in Taipei. Now, if you're a Bloomberg subscriber, you can catch up on that specific interview and some of the ones that you might have missed, of course, from Hon Hai Day, and of course some of the other conversation we just had. We had a very lengthy conversation, short and longer term implications and opportunities and risks to this Chinese equity rally with Nicholas Yeo of Aberdeen. Catch that and more by going to TV Go. Plenty more ahead. This is Bloomberg. All right, you're back in time for an update of these markets. Day two in China post the Golden Week, up 5% yesterday at the close. We're down 2% on the main benchmark. Things were a lot worse. A few minutes back, we were down as much as 5%, but it's early days. Who knows where this goes?
Yeah, off some of the lows, as you mentioned there, but most sectors are still in the red in the A-share market. Hong Kong doing a little bit better. But yeah, it's coming up in the next hour. Talking a bit more about metals, as well as really the macro side of things with the Fed as well, with State Street. This is Bloomberg.
What's happened in terms of the announcement on policy support effectively takes out some of the downside risk to growth. Offshore market was trading at 8.4 times forward price earnings ratio, very, very low. We think it's worth about 12. Now, in the course of the rally, it got up to just shy of 11, and now we're back down to 10.8 as of last night's close. So we still have some, what call it 1.5 multiple points we could expand, and as we go through time, some earnings growth, and you put those two things together, you get 15 to 20% without stretching the imagination.
The key here is that the domestic investors are also in the market right now, right? People are opening an account and they do not deliver. The credibility issue might be back again, right? Because we have many false dawns. Can the government afford another one, right? I mean, part of the stimulus, if you like, the rollout of all these aggressive stimulus was also the social unhappiness, right?
Yeah, markets have spoken. The message to President Xi might be we need more follow-through when it comes to fiscal stimulus after what we heard from that NDRC meeting. Were expectations just too far, too much, really, that we were going to get anything yesterday? But yeah, you got to wonder, why did they have it in the first place?
Right. And, some of the theories out there were maybe just to temper expectations because the market was headed vertical. And, at some point, anything that goes up in a straight line is scarier than something that, at least in my head, one is, has the market re-rated enough that at least if we do drop, it won't be all the way back down, but at a higher low, right? Number one. And number two is, if markets are looking for some more announcements of what? Because at some point, those announcements will have to bear fruit to something, whether that's good corporate guidance, earnings guidance, or economic numbers, right? And, the economy will take time to respond to any announcements. So they could come up with a press conference every day, but what else could they say that, at some point markets will read through these lines and look at these markets and say, hey, valuations are almost back to levels. What do we do now?
And does the MOF, the Ministry of Finance, just need to come through, right? This is what Morgan Stanley was saying, that they might need to do a follow-up press conference after what we had yesterday with the NDRC.
Well, speaking of,
and they were saying, right, a fiscal package of 10 trillion RMB is needed in order to achieve what they say is sustainable reflation. But that's something that people are saying are very big numbers right now. But I think there's still one more meeting, right? I think mid-October, early November, MPC.
And, the standing
That might be the next
committee.
catalyst to watch now.
And then we move into the Central Economic Work Conference. We keep talking about, to your point, we keep talking about 10 trillion. I was having a conversation with some economists yesterday, and of the 1 trillion that has been laid out this year in terms of special purpose bonds, right? I think a third have been earmarked for projects, a third have been used up. So not even that has been used up, right?
Yeah.
So we have to talk about how that gets deployed to the economy, and then we can talk about supplementary moving forward. Now, speaking of, I think, let me just look at my headlines right now, because I think, here we go. Our producers are helping us out. There is we'll get more details on this. The Housing Ministry and the NFRA are holding a meeting on the housing market. That's all we know so far, so don't let your imagination run wild. As far as markets go, we're down about 3%, 3.7%. Every single sector's down. 85% of stocks are down onshore. So we are giving up most of the gains that we got in yesterday. Turnover is still the name of the game. Nicholas Yeo, who you heard from earlier from abrdn, said liquidity is back in his market. At this point in time, in fact, 30 minutes in, turnover is already above the year-to-date average with almost a full trading day left. At least this has really reignited spirits and interest back into this market.
And as you said, and as you asked him, is that it puts us in a new range, at least when it comes to these China equities.
Yes.
Now that we have seen this re-rating and valuation. Certainly that's going to be the key thing, is how sustainable this is going to be. But, as he mentioned, that rotation yesterday out of H to A, it's a bit of a reverse here today. But he mentioned, is that going to be sort of the prelude to what we're seeing in the A-share market if we don't see these fiscal measures deliver? So that certainly is going to be the key question in the next few days or months. If you take a look at when it comes to the rest of the markets, though, we're still kind of holding okay when it comes to stocks and risk assets. And I think what we saw in the U.S. session with NVIDIA up for 5 straight days, that certainly is one thing. Those Fed cuts and, the whole kind of no lending scenario, I think those sort of fears are a little bit coming through and fading here a bit here as well. But the Bloomberg Dollar Index, keep in mind, we're still on track for an 8th day of gains, I believe. That is the longest streak we've seen in about 2 years. So that could also be some sort of headwinds here for equities here today. But you're seeing decent bids across most markets. China's obviously doing something separate here, but we're watching very closely oil markets, for example, metals, for example, which basically sort of fell out of bed yesterday on the back of this disappointment out of China. It looks like things are looking a little bit better.
Yep. Let's bring in our team to dissect and diagnose where we are on price action and where we go from here, short term at least. Mark Cranfield is with us out of Singapore, MLive strategist, and here on set with us is our Bloomberg opinion columnist, Shuli Ren. Mark, let me start with you. This cooling down phase we're looking at in markets, expected, nothing goes up in a straight line, but should we be concerned that this could go even further lower from here?
Yeah, I think it'd be surprising if the Chinese equities and the Hong Kong equities that focus on China, if they didn't settle at a lower level before confidence is restored. I mean, the swings have been really quite extreme by any standards. People are used to high volatility in greater China markets, but to see the kind of things we've had in the past couple of weeks is really quite abnormal. So with the huge amounts of money, you've been talking about the turnover going into it as well. So that obviously means there's a lot of fresh money. Some of that won't be very patient. They'll be looking for very quick returns on what they've been doing. That was partly the disappointment yesterday with what we heard from the NDRC yesterday. So people don't really have the patience to stick around and wait to find out how quickly they're going to get paid back in this. And when markets start to fall, they'll be very fast to turn over their positions. So it'll be surprising if we don't settle at a slightly lower level. But with all the things put in place, it suggests that there is a turning point taking place. It's just that you need to have a stomach here to be able to sit through the high volatility in the first place and wait for things to stabilize.
Shuli, the NDRC meeting yesterday offered pretty much nothing substantial. Is that a sign that policymakers may be stepping back from stimulus after this rally?
I wouldn't necessarily read that, but the NDRC's officials did sound too relaxed. Maybe they just had a vacation and they're coming back very relaxed. And that's a really bad sign because like what David just said, like all the money that has been budgeted for fiscal spending at the beginning of the year has not been spent. And it's NDRC's job to make sure that the projects get approved, that they get implemented. And the traders just feel that NDRC was being too relaxed. I mean, no one expecting them to announce, 10 trillion yuan fiscal stimulus. It's not their job. It's the State Council's job or Ministry of Finance job. But the tone of from the officials, they were just talking about empty slogans, saying that China's economy was stable and making progress. The tone was just not good.
Well, it's a developing story still, right? And at this point, arguably, the fact that we're talking and have dedicated such an enormous amount of airtime talking about this means that they might have really turned the page here on the story. Your column that's out just very recently is that President Xi Jinping can't get cold feet right now. Like, at this point in time, officials really need to deliver. Just take us through the thinking here of your opinion column.
I mean, you can cry wolf only those few times, right? Like the Chinese people already have a lot of skepticism in terms of whether this government still got it. We had that cat's bounce quite a few times. And this time, before the Golden Week holiday, they came out with big guns. Like the Politburo meeting was a surprise. They talked about fiscal spending, right? And then the PBOC was doing a swaps facility to prop up the stock market, and they were talking about recapitalization of big banks. These are all very, very unusual measures that we have seen perhaps the last time in 2008. So naturally, people are saying, okay, let's compare 2024 to 2008. 2008 had 4 trillion, and 2028 should have at least 10 trillion yuan. So that's a very natural comparison, and people are already buying into it, and they just have to follow through. Otherwise, the government's credibility is just gone.
Mark, I was going to get you to another story, which was just broke a few minutes ago, about the U.S. is weighing a breakup of Google as sort of a remedy in this monopoly case. Obviously, we haven't seen a big reaction in NASDAQ futures, but certainly, what would this mean, that these crackdowns on big tech, you think?
Well, I think initially it would make people pretty nervous of the big tech companies in case anybody else was pulled in for a similar kind of scrutiny as well. It will need quite a bit more detail, and it's not a complete surprise. I mean, people who have been following US tech market will know that the largest companies there have been under some kind of watch. There are people complaining that they have too much of a monopoly over various parts of the tech sector. But for them to actually go through with it, if it actually leads to the situation where they legally are told to break up in that respect, then people will certainly be quivering, because it could mean the same for one or two other major companies as well. So on the face of it, it's a negative for the tech sector in the US. People will want to see more detail, but we'll only really get a strong read once US markets open, because that's where the majority of the trading takes place for these kind of companies. But certainly it's very hard to put a positive spin on something like that.
Team, thank you so much. Mark Cranfield there in Singapore for us, and here on set, Shuli Ren, our Bloomberg Opinion columnist. Coming up on the show here, we'll continue to talk markets globally and geopolitics with State Street. They'll be joining us shortly. And a question over what did we hear from China recently that might start to show up in the economic numbers, particularly in cyclical. So really the bread and butter of Matty Zhao out of BofA, who joins us later this hour. So lots of good conversations coming up as markets continue to sell off in Greater China. This is The China Show.
Space, the next frontier of the tech sector. On Friday, Bloomberg Technology is live in LA for a special episode from Rocket Lab, featuring conversations with founders and investors of the companies plotting humankind's future outside of Earth's atmosphere.
We're going to get hands-on with the future of space technology, from rockets to robots.
Countdown to 11 a.m. Eastern, 8 a.m. on the West Coast, only on Bloomberg Television. Context changes everything.
Looking ahead, preserving the current favorable economic conditions will require adjusting monetary policy so as not to unnecessarily restrain demand. And that will require a careful data-based approach as we balance the risks, and there are risks on both sides.
And that was Susan Collins, of course, out of the Boston Fed, discussing really maybe the slower pace of rate cuts from here on, as they say, right? The first cut tends to be the deepest. Fed pricing right now, looking at the November meeting, so not a full cut is priced. Currently, it's a dance, as one of our guests this week has pointed out here, on a daily dance, so 22 out of 25. But as you can see, of course, the curve still points to deeper cuts as we move into the first quarter of next year. Joining us here in set, Noel Dixon, Senior Macro Strategist at State Street Global Markets. Nice to see you, sir. Good morning.
Good morning.
I'm looking at some of your notes here. You're saying that the Fed is cutting into strength. Is that the same thing as saying they're making a policy mistake?
I wouldn't say they're making a policy mistake. I think they're just being cautious. I think one of the biggest things in their last press conference was the QCEW, the revisions in the jobs numbers. So I think given that they had 2 more jobs numbers before the next meeting in November, it made sense for them to, I think, take the cautionary move of doing 50. From here, I do think, though, however, they're going to be a little bit more cautious and steady with the rate cuts.
Yeah, this whole risk of a no landing scenario now, Noel, I'm just wondering, I think Mohamed Al-Arian said it's almost like you've lost that anchor in the bond market. Do you think that takes the floor out of this Treasury market right now when it comes to where yields are?
I do think the floor of the Treasury market is still there on the long end. I think fair value is definitely above 4%. Not just because of I think the U.S. economy is still resilient, but I think the next question, of course, is where is the neutral rate? And I think the neutral rate's probably higher than I think most investors probably think at the moment.
Right, and in a couple of weeks, it's to your point, we have elections taking place, and it almost doesn't matter who wins. They're probably going to build up more debt.
That's right.
And it doesn't sound like I want to be anywhere near the Treasury market at the current level.
Yeah, I agree. I think, Trump is scheduled to, based on current policies, add about $4 trillion to the national debt over the next decade. Harris, however, although she's less than 50% of that, still $2 trillion to the national debt if you look at dynamic scoring. So however you slice it, I think the long end is definitely, there's a floor under the long end.
How do I look at what we're seeing in oil prices, for example, this recent surge up into maybe yesterday, but break-even rates are, I think, higher now, I think around those 2-month highs. Do you think central banks are going to have to respond to some of these inflation concerns, or is it really going to be more about the growth side of things?
Yeah, I think at the moment, no. But I do think if we continue to get a nonlinear move in energy prices, obviously central banks globally are cutting rates, so that's an injection of liquidity. You have China potentially putting forth fiscal stimulus. That could totally be an issue, I think, as it relates to reflation with commodity prices.
The brewing tensions in the Middle East, and I think we just had a report out of Axios here talking about how President Biden and Prime Minister Netanyahu, just reading that headline out here, that a call is to come as Israel mulls an Iran strike. The simple reason I bring that up is markets so far, apart from oil, have looked through developments in the Middle East. Can we assume that continues, or is there a point at which all bets are off, and hopefully we don't get to that point?
Yeah. Hopefully we don't get to that point. I think for now, markets will look through it. But I do think Iran will be a major factor here in how they react and how Israel ultimately reacts in this situation. And if we see that it's a broader escalation, I think markets are sanguine and think things will resolve themselves. But if it looks like it's going to escalate further, then I think we will have a problem on our hands.
And you mentioned it's only in the oil markets. Are we likely to see that being spread across asset classes? G10 FX volatility, for example.
Yes,
yeah, absolutely.
Yeah. So I think you get your quintessential, I think, risk off move. You get a stronger dollar. I do actually think you get that could be supportive for duration in that circumstance. So that'll be definitely a different trading environment than we currently have.
I think you mentioned China briefly just now as well. How are you guys thinking about China? This whole everything that's gone on.
Sure. I think right now it's I think they built up a lot of expectations and anticipation for some fiscal stimulus, and I think the bar has been raised pretty high at the moment. I do think there could be some legs to it, and there could be some durability. It does seem like they want to turn things around in China, so I think that's positive. But at this point, I think where we're at from a tactical perspective is we need to see some proof in the pudding as it relates to fiscal stimulus.
Yeah, I guess just to build on your point, one of the more common narratives that we get here is, when we ask about China, it depends who you ask and where they are. The closer you are to Beijing, the more sanguine they are about the situation. The further out you go, the higher the bar for them to be convinced that this is a buy. And I'm wondering, have you noticed a difference between the people you talk to, you're visiting the region, from the people that you usually talk to, of course, where you're based, between, how they think about what the China exposure should be?
Yeah, absolutely. I think, definitely in the U.S. and I think Australia, they're a little more sanguine about the stimulus. Their allocation, I would say, to China is a little less so than I think some of the Asia Pacific countries. When I was in Korea, for example, they have high exposure. So I do think there's definitely differences regionally.
Noel, thank you, Noel Dixon there, senior macro strategist at State Street Global Markets, joining us here in our Hong Kong studios. We've got plenty more ahead. This is Bloomberg.
Right, welcome back. Now, JP Morgan CEO Jamie Dimon says the Fed was right in making a 50 basis point rate cut to avoid recession and tackle rising unemployment. Now, Dimon spoke exclusively with Bloomberg, also weighing in on the U.S. economy's trajectory and also current valuations in this market.
Soft landings are hard. I hope it happens. I don't know. I just wouldn't count my eggs in that one.
Do you think
and markets are open. When you say open, they're very, values are high. They're not low. Both equities and bonds, credit spreads are very low. So they're open, but people are saying they're not open for IPOs. So some IPOs, when we just did one of the largest ones of the year, like last week, they're open for those who the market wants to buy today. But don't assume that they're not open. And, sometimes people would go public, they don't like the price. That's a very different thing. And you should think twice about that. When you think you know what a company's worth much more than the market might know.
That maybe it's an assessment of what you're looking for rather than the actual market being closed.
Exactly.
You said that there are a lot of inflationary things that are coming down the pike. Do you think that it was a mistake for the Fed to cut by 50 basis points?
No, actually. I mean, you got to separate the here and now. Inflation has definitely been coming down. They don't want to go into recession. Unemployment has been going up. They raised rates. They were late raising rates, but they raised it very high, rapidly to 5%, which I think is the right thing. And they're right to take their foot off the gas in that one. I don't think it matters that much, 50, 25, honestly. But I think that was okay. If inflation comes back, I'm looking at future things. The remilitarization of the world's inflationary. The fiscal deficits of the world, particularly the United States, are inflationary. The green economy is inflationary. Demographics are inflationary. It's very possible energy prices down the road, I'm talking about 2 or 3 years, will be inflationary. Those will hit later. Now, they should react at that time to those things, but I don't think you can anticipate that. We don't know that that's going to happen.
I'm so glad you brought up the deficit. I watched the Treasury auctions. There's another 3-year one today. I watch them every time wondering, are we going to start seeing disruption from some of the concerns that that you bring up, but also every single investor who I speak to says the same thing. Are you surprised that the market hasn't priced in a higher structural deficit in the way of higher yields or at least more volatility, at least at auctions?
Yeah, well, I have a lot of comments on that one. Commodity markets often don't price things in until they actually happen. And so it hasn't happened yet. The higher inflation, the higher structural stuff, even though the deficits are there, there's also sentiment, inventory, supply and demand of capital goods. So it's very hard to say. But that's why I think that longer rates may actually stay here and tick up a little bit as opposed to go down because of these huge deficits in the United States. And then the market's reacting, which the word you used of volatile or something like that. It's not always bad. I mean, I think we overreact sometimes to volatile markets, but I do think they'll happen again. Dealer inventories are very low. The big market makers are very constrained. Not today. I mean, we have this anomaly where JP Morgan is going to have $1 trillion of cash, and unable to intermediate in treasury markets or repo markets completely conservatively, because we're required to hold that cash in very, like central bank reserves, something like that. So I think when QE finally gets to a certain point, you will see that. I may be wrong. And again, if it happens, I don't think it's a disaster. It's not bad for J.P. Morgan. I do think policymakers will get upset. They don't like seeing that type of thing, and I think there are fixes to it, and I think they should start working those fixes today.
J.P. Morgan CEO Jamie Dimon speaking exclusively with our colleague Lisa Abramowitz there. Just some breaking news across your terminal here right now when it comes to Boeing. So we're hearing from the plane makers that they are now withdrawing that union offer, saying that talks don't make sense right now. Their offer to the union was withdrawn, and union did not seriously consider our proposals, is what the company is saying here. What does this mean? We've already heard that there is a risk of S&P downgrading that credit rating for Boeing to junk if this strike does go on. So we'll continue to watch the story and give you some more details once we have them. Plenty more ahead. This is Bloomberg. Heading to that lunch break in Tokyo here, and this is what Japanese markets are doing at the moment. So at least when it comes to Asian stocks, looks like we faded some of the momentum in the early get-go. But, the Nikkei 225 still punching about 0.6%. Seven & i certainly is the big story out of Japan here today. According to our sources, Couche-Tard is looking likely that they will up that offer for the company. What does that mean? Does that really mean that Seven & i is going to have to respond in some way? Earnings also come out this week as well. The topics is unchanged. A bit of weakness in the yen. We're talking about 148 levels right now. We have seen a bit of a resurgence in the dollar of late, Dave.
Yeah, I think 8 days, is what you're...
8 days, yeah.
8 days in a row. It's busy in breaking news. To recap one other point that's coming through right now, out of Taiwan, the China Times reporting that Taishin shareholders have approved this merger with Shin Kong, and perhaps we'll get more on that. We did get to you guys a preview earlier on against the backdrop of, as Yvonne is pointing out, markets that have lost some steam. We're flat on the benchmark. We're lower on S&P futures. We haven't even talked about the potential breakup of Google that the U.S. is weighing. We'll get to that, in fact, in a few minutes or so. But yes, it's really all about what's been happening in China, this back and forth, this massive rally, and this pullback that we're now seeing across most of the benchmarks. I think we're now down 3-4% on the CSI 300, if not more, on top of, and we're down in Hong Kong, on top of the 10% declines we had yesterday. Speaking of, a glance at commodity markets, everything from oil, which should be pulling back after it played some catch-up yesterday, iron ore and thallium, rebar futures, copper, and also bottom of your screens, AAA, of course, is a ticker there for aluminum. Prices 0.8% to the downside.
Yeah, I mean, I think that was one of the first asset classes to really react to that disappointment to the NDRC. Was you saw in the commodity complex here after what has been a pretty stellar rally when it comes to metals and the like leading up to that NDRC meeting, and of course what we heard from the policymakers, just a week before that. So what does that mean? Where does that leave us? Joining us now is Matty Zhao, head of APAC Basic Materials, Oil and Gas Research at BofA Securities. She's also their co-head of China Equity Research. I mean, is this pullback healthy, you think, at this point? What does that leave where commodities are, given that there's still a bit of disappointment and uncertainty of where policy is going to go in China?
Yes, I think first of all, the rally was probably more driven by the sentiment on the policy, and also a lot of the rally is also because before the policy announcement, a lot of the sector was in deeply loss-making. So, for example, for steel, they have been loss-making for 21 months already in the past 2 years. Right, so they are really having some cash issues. So whenever the sentiment improved, they actually took the chance to increase. So before yesterday's meeting, like steel prices were up 20%. But what we have seen in fundamental is nothing has, fundamentally changed yet. Like steel demand has still been very weak. We're still having high iron ore inventories and all those. So I would say the pullback should be like healthy as well. And even we raised some of the earnings in our sectors, we didn't assume that all these rallies or the announcement would be fully executed.
Your top pick is top sector pick is aluminum. Tell us why and how does it dovetail into, I guess, broadly the lack of detail so far and why aluminum does stand out to you at this point.
Yeah, sure. I think aluminum is a balance between whether the stimulus work or not work, right? So even without the stimulus, we are assuming aluminum demand to go up by 6 to 7% this year. That's driven by the grid investment. So year to date, grid investment was up 23%. A lot of them is spending onto the ultra high voltage, which is more aluminum intensive than copper. And we are expecting the ultra high voltage to grow at a 45% CAGR. So grid actually accounts for about 20% of aluminum demand now. And then the other one is the lightweight trend in the transportation side. So if you look at the EV, they use 30% of aluminum compared to the traditional ICE car use 10% of aluminum. So the EV hike and of course now more of a mid to low end auto sales improvement is also using lightweight trend as well. So auto use of aluminum was up more than 10% year to date as well. So these two combination is already driving aluminum demand to up 6% this year. Of course, property is still a drag.
Yeah.
We are expecting property to probably go down by 10% and another 20% for use of aluminum because of its more later cycle use. This property accounts for about 20% of aluminum use, and if we do have the stimulus continuing and we are seeing the golden week, the property sales are starting to pick up very strongly, like the tier 1 cities like Shanghai, Beijing were up 100%, but whether this is sustainable is a question, right? So, yeah, I mean, even without the property, pickup, aluminum demand is still healthy, and we have no supply growth this year, given we are reaching the cap of aluminum capacity, and we are having a lot of the safety check in Shanxi and also in Henan, at least until the Chinese New Year, impacting the mining sites on the aluminum front.
And so that's why, I mean, you're still thinking what you said, 10% drop in housing starts for next year. What does that tell you about construction-related, materials, the like? Is that still going to be more the laggards in what you cover?
Yeah, so we are expecting, like, for example, steel demand to drop about 4%, and of course that will affect iron ore demand to drop 3 to 4% as well. Globally, we are expecting cement demand to go down by 5-6% next year after 8 to 10% decline this year. So that's on assuming that this policy is not enough to push up or have a structural change in property at this moment. Of course, if later on we see more physical stimulus in the next few weeks, that's what the market expects, then maybe that would help. But so far, we haven't seen such things happen yet.
Yeah, well, to pick up on your point, one of the headlines that came through yesterday, I'll read it for you just in case you missed it. So China will bring forward $200 billion of 2025 investment projects. That it sounds like a big number, but there's not a lot of detail there just yet. What's your understanding right now of this push for infrastructure right now? Do you have enough detail?
No, we don't have the detail on the top line number yet. But based on what's need to be invested, if you look at like the railway, the road, the municipal project, a lot of them is actually already fully, or you can say very well invested in the past few years. So it's very difficult to further exceed that. That's a lot of them are very steel and like cement intensive. But on the other hand, we think like the power grid, the power storage, and a lot of the new infrastructure, which are more metal intensive, still needs a lot of investments. Like, a lot of the solar and wind, we don't have enough linkage into the grid yet. So those are the areas that we really need. And of course, underwater pipelines, the oil pipe, etc. All this infrastructure may have the real needs for the investments.
What would make you more positive?
I think a few things need to happen. One is the physical stimulus that we really see in infrastructure. And of course, where are they investing in will be very different for different commodities, right? Are they investing into the traditional infrastructure like road or railway, or are they going into the grid, etc.? But I think the market now is expecting probably a 2 trillion or even more on the physical stimulus. So that's one thing. Secondly is the continuing push for this property, because the golden week is only 1 week, right? on the response to the policy. But if this continue and if the property actually become like stabilized, not to say to grow next year, that would be very positive for the commodity overall. Consumer confidence is another thing as well, that consumer confidence have been reaching multi-year low. But of course, maybe the property market and also the stock market will help the wealth effect to push up consumer markets. So those are the things that we watch for.
And just turning it back directly to equity markets, what do you think about valuations now? And what do you suspect in terms of the many equity sectors you cover, where you might see the biggest earnings revision up?
Yeah, sure. Actually, if you look at the construction material, which are very property exposed, so for example, cement, steel, and glass, a lot of them is trading at about 40 to 60%, on the PB perspective versus the past 10 years average. Yeah. So which is you are still having 40 to 60% discounts on that. So valuation-wise, it's not very expensive. But on some of the the yield named like the SOEs, like the coal and the oil names, they're kind of in line with valuation. So in terms of earning revision up, given that a lot of these construction materials are at very, very low level or loss making, a little bit tailback or a little bit improvement will mean 50, 60% earning revision ups.
All right, Matty. Thank you, Matty Zhao there, head of APAC Basic Materials, Oil and Gas Research and co-head of China Equity Research at BofA Securities.
Yeah, before we just get you a look at some of the stories making headlines, just an update of these markets, and you probably just saw that as well. The CSI 300 is now approaching 6% losses, and we're just about to take out, if this goes even further, take out the 4,000 level. So at the moment, we're now hitting session lows in this, so we've effectively completely reversed the gains that we had yesterday on a closing basis here. Okay, there we go. More on that in a moment. Now, right, China is, and on the stories here that we're tracking, China is investigating whether to raise these tariffs on European large engine vehicles and will start collecting these levies on brandy. Now, it's an escalation of their trade spat after the EU voted last week to impose tariffs of up to 45% on Chinese EVs for 5 years. The European Commission says it will challenge the Chinese measures on brandy at the WTO. Now, Hyundai is seeking to raise as much as $3.3 billion here through an IPO of its Indian unit in what could be the biggest ever listing in the country. Now, Hyundai has set the price range as high as $23 per share, which actually could value India's biggest car maker here by sales at about $19 billion. Now, the IPO will open for bids next week, with shares expected to start trading on October 22.
Now to one of the big stories here this morning. The U.S. Justice Department says it may push to force Google to sell off parts of its operations. In a court filing, the DOJ lays out other potential remedies to a judge who found Google illegally monopolizing the search market. Let's get more now from our tech reporter, Annabelle Drewlers, with the latest. Annabelle, this would be a historic antitrust breakup.
Yes, certainly. I mean, it's the first time that we've perhaps seen Washington really trying to break up a major tech player since Microsoft, and that was unsuccessful about 2 decades ago. But this is a 32-page document that was filed by antitrust officials on Tuesday to the judge who found that Google had illegally monopolized the search market. So the ruling has been already made. It's really about the remedy now and what needs to be done here. So the DOJ is looking at behavioral, structural solutions to the problem. They're basically trying to prevent Google from using its products like Chrome, like Play, Android to advantage their own Google search engine over others in the market. So the things that they're looking at the most extreme end is forcing Google to sell off part of its operations. Another could be looking at forcing Google to supply the underlying data or give access to the underlying data that it uses to build its search results and artificial intelligence products. They could also be looking at requiring Google to allow websites more ability to opt out of its AI features. So there's lots of different remedies. As I said, this is a 32-page document, but certainly this is something that Google really does not want to see.
Okay, well, that might be unsurprising. Do we know anything more, Belle, on any reaction from the company so far?
Well, we just had some lines just crossing now from Google giving their response to this. So they're saying that the DOJ is, the proposals from the DOJ rather risk hurting their consumers, their businesses. I guess that's a little bit unsurprising. They're also looking forward to making their arguments in court. And remember, of course, this could end up being quite a drawn-out process here. They're saying that the blueprint as well from the DOJ goes well beyond the legal scope of the court decision. So certainly quite a strong reaction from Google. You could probably expect that, of course, given the extremity of what the DOJ is proposing in that 32-page document. But still, as we said, it's the first time we've seen the DOJ or that push from Washington to break up a major tech company since Microsoft. And again, that effort was unsuccessful.
Belle, thank you so much. Annabelle Jewelers there with the latest on this breaking news story just in the last hour or so, joining us out of Taiwan. Very quickly, a brief market check right now. So, yeah, the sell-off is continuing in Hong Kong. We're down 1.5% on the Hang Seng Index at 25.25 right now. It's really the story onshore, where at one point we were almost close to taking out 4,000. We were down as much as 6% at one point a few minutes back on the CSI 300. Turnover is soaring. About an hour, 73 minutes into the session, and turnover has now topped 1.5 trillion renminbi. Plenty more ahead. This is Bloomberg. All right, market check on our right. We're literally, as we speak, rewriting our headlines. We were down as much as 6% on the CSI 300, now down 5%. The majority of stocks onshore are down, to say the least. So, case in point, Shanghai Composite, where we effectively have about 2,300, 400 stocks, 2,100 stocks are down on that specific index. So we've, at these levels, almost erased the gains we had yesterday. On the Hang Seng Index and here in Hong Kong, we're down a further 1% on top of the 8-9% drop towards the close yesterday. So, yeah, these markets are taking profits given how far and how quickly and how fast these gains have become. You know what? At these levels, we're still up 25-30%. So it's still been a very good month.
Yeah, you got to wonder, is this negativity misplaced in some ways? That you are seeing more of these analysts that come through on the show saying, look, there's no way we could have kept going as vertical as we had seen, right? That this pullback is necessary and in some ways healthy, and it makes stock selection a little bit more easier just after what we've seen. So certainly, we are seeing this cooling down, right? I think Mark Cranfield had it right. It's a consolidation. You can't really quite call it capitulation just yet, just given the run-up we had to this here. So we are seeing another day of a pause here today as well. Certainly that is going to be the big question, though, the sustainability of this. Is this the beginning of some sort of pullback that's going to be bigger, given just how quickly things went up? But yes, I think most for this whole NDRC disappointment, when, I think Bloomberg Economics called it, right? That the fact that there was no Ministry of Finance there, investors are likely going to be disappointed, and we definitely saw it.
Yeah.
Are they going to see some sort of follow through? I think Nick Yeo from abrdn had a very good point, right? Now that you have retail domestic investors that are back into this market in a big way, China cannot afford another false dawn.
Yeah.
So they might have to follow through with these fiscal policies.
It is affecting now a broader part of the consumer base, right? So I think some of the numbers that came through in terms of the number of new brokerage accounts, 3 to 4 million, I think was what our guest yesterday talked about.
It's nuts.
Going into today. And you know what? This is classic headline risk where markets are literally reacting to any time there's a whiff of a potential press briefing. That's not even a confirmation of a press briefing, right?
Yeah.
And you got to wonder at some point, what more can officials really say? I mean, you can have a press briefing every day, but at some point the numbers have to start lining up. I think Morgan Stanley came up with a very good point today when they said, you know what, our current price targets for these stocks, apart from Hang Seng China, the gains are probably in for now.
Yeah, well, they've already priced in enough of these reflationary measures. I think Eva Lee from UBS said it, right? If we don't get any stimulus, we could stay at these levels, basically, into year end. All right, that is, of course, one of the big things we're watching trending in China here today. A look at what's making headlines in national newspapers and grabbing attention on social media, and it is about the market chatter. All right, now, let's bring in our China correspondent, Minmin Lo. Minmin, what are people saying now?
Yeah, certainly a lot of market chatter around dinner table conversations and on Weibo as well. Many of these hashtags circulating: A-shares opened higher and then fell back, A-shares roller coaster, A-shares being backstabbed. There is a theory going on social media, people saying that the rally is being hijacked by expectations of Fed cut that is causing Asian currencies to strengthen, and that's weighing on some of the Asian indices, but also an acknowledgement that some of the surge and interest on mainland market shares now is driving a lot of that volatility. Take a look at some of the social media users' comments. Some of them are saying that this is a casino. It's a familiar story, clearly from someone who has been burnt before. Some of the other social media users also saying this is like the Golden Week holiday. It seems like everyone thinks they're so smart, and as a result, they are the ones getting stuck on the road, just crowding onto their trade now. Take a look at this one, saying that, you know, it's a roller coaster ride. Those who are faint-hearted shouldn't be in this game. So I guess, you know, just anecdotally, we've seen millions of new accounts being opened over the Golden Week, and this outpour of interest into the stock market, and a lot of people wading in with a bit of trepidation and a bit of excitement into the stock market.
Well, you need a bit of both, really, in life. So the stock market, I guess, is analogous, really, to the ups and downs of, if you're lucky, our brief 90 years in the spotlight. Anyway, I'm getting fairly deep. Minmin, thank you. Minmin Lo, our China correspondent. To Minmin's point, right, 10-day volatility on the CSI 300, effectively back to levels during the boom and bust. And hopefully we don't get into the bust phase of the conversation back in 2015. We are seeing declines, though, from about these 91, 92 levels in the RSI. So we did hit fairly extreme levels of momentum going into this session today. Plenty more ahead. This is Bloomberg. Right, if you're just joining us, some breaking news earlier on in Boeing, and yeah, talks with the union collapsing, not a third time lucky. Danny Lee, our aviation reporter, is here with the details here. Danny, why did both sides walk away, or which side walked away?
So it seems Boeing took the first step and said it was walking away from what is a third round of talks here. And so they said that the union, the machinists that represent its biggest union workforce, didn't seriously engage in their latest offer. And so both sides are now trading blows and rebuttals on who's to blame here. But ultimately, this is still bad news for Boeing, because we are now almost into a month of strikes, and Boeing is flirting with ratings downgrades, and this really undermines its efforts to keep, for example, its investment-grade credit rating.
Yep, that certainly is a threat or a risk, given what S&P just mentioned this morning. Denny, thank you with that update on Boeing here. We'll see what comes through once U.S. markets do open up. In terms of the market check, it is still very much this fizzling rally that we're continuing to watch here today. And there you go. You continue to see 5% losses for the CSI 300 and Shanghai Composite. So basically, as Dave mentioned, erasing most of the gains that we saw, if not all, that we saw yesterday, post-NDRC, post-Golden Week reopening today. Dave, what else are you watching? Turnover certainly is still the key point today.
Yeah, I mean, turnover is still quite good. So I think if you had to latch on to which group of stocks might get an earnings upgrade, I have to emphasize the word might, is really the brokers, right?
Yeah.
They've really seen business spike of late. So up or down, it's really become a trader's market. There's interest here. Margin debts is another metric that we've been tracking very, very closely. There's a fairly strong correlation between how much outstanding, margin debt goes up and where prices go moving forward. All that being said, we have to take this almost not just on a day-to-day basis, but almost on a minute-to-minute basis, because this market is gyrating all over the place, currently down about 5.7% onshore as we enter the last 30 minutes of the morning session.
Yeah, and it just goes to show how sensitive or obsessed this market is on anything that has to do with policy. here right now. We'll continue our coverage there. That's it for us here in China Show. But Bloomberg Markets Asia is up next. Stay with us.